The meteoric rise of Palantir, an artificial intelligence-focused software powerhouse, has drawn significant attention throughout the investment world. Since the start of this year, the company's stock has soared by more than 70%. When compared to other publicly traded businesses boasting a market capitalization of at least $200 billion, no other name has delivered anything close to that kind of return. This sharp increase has captivated retail traders and institutions alike, prompting widespread discussion about Palantir's future trajectory in the rapidly evolving artificial intelligence and big data landscape. However, one legendary investor who continues to keep his distance is none other than Warren Buffett. Despite the excitement surrounding Palantir's performance and future potential, Buffett has shown zero interest in the stock. In fact, based on his long-established investment philosophy, there are compelling reasons to believe that Buffett would not only avoid Palantir stock, but would do so emphatically. To fully grasp why, let's break down the three primary reasons behind Buffett's likely aversion to this high-flying artificial intelligence name. To begin, Warren Buffett has always prioritized understanding a company's business model before allocating any capital. During Berkshire Hathaway's most recent annual shareholder meeting, Buffett was asked whether he had identified any major opportunities to deploy the company's enormous cash reserves. His answer was crystal clear. He would be willing to invest as much as $100 billion in a single business, but only if he could comprehend exactly what the company does and how it generates value over time. This principle is foundational to Buffett's strategy. He has often emphasized that if a company operates within a domain he does not fully understand, no matter how promising it may seem on the surface, he prefers to pass. While it is true that Berkshire Hathaway has held positions in technology-driven businesses in the past, those moves should not be mistaken for a change in Buffett's personal comfort zone. A perfect example is the firm's investment in Snowflake, another cloud-based software provider deeply involved with artificial intelligence and data management. Berkshire Hathaway poured $800 million into Snowflake, but this decision was widely believed to have been made by Buffett's trusted investment managers, Todd Combs and Ted Weschler. These two lieutenants have increasingly taken on more responsibility in shaping the conglomerate's portfolio. Even major business media outlets at the time suggested that Buffett had little direct involvement in the decision. Supporting that idea is Buffett's own admission that he does not fully understand artificial intelligence. He's made similar statements in the past about industries or technologies that lie outside his core circle of competence. Palantir's core operations, heavily focused on artificial intelligence, big data analytics, and government contracts, are rooted in a level of technological complexity that likely exceeds Buffett's threshold for comfort. Given his consistent preference for straightforward business models with predictable outcomes, it is highly improbable that Palantir's narrative fits his investment mold. Buffett has built his reputation on identifying businesses with transparent earnings models, enduring competitive advantages, and simple products or services. In contrast, Palantir is pioneering advanced software systems that solve intricate national security, defense, and enterprise data challenges, often far removed from consumer-facing simplicity. This alone would make Buffett think twice. But let's suppose, for the sake of argument, that Buffett were to overlook his discomfort with Palantir's technical complexity. That still brings us to a second major reason for his likely aversion: the inability to reasonably forecast the company's long-term earnings. Buffett has made it abundantly clear throughout his career that his first step in assessing any potential investment is determining whether it's possible to predict the company's earnings over the next 5 years. This point was emphasized in a shareholder letter he wrote back in 2014. He explained that if he cannot develop a logical and reasonably accurate projection of future earnings, he immediately moves on to other opportunities. There is no room for speculation in his process. Palantir's business, which is heavily reliant on contracts from the United States federal government and its allies, introduces a high level of uncertainty. While these contracts can be highly lucrative, they are often short-term, politically influenced, and subject to abrupt changes in national priorities. Revenue from government contracts is inherently difficult to predict because it depends on a number of external variables such as election outcomes, policy shifts, international relations, defense budgets, and geopolitical tensions. Even someone with decades of experience and insight like Buffett, often referred to as the Oracle of Omaha, would find it difficult to predict how government relationships and budgets will evolve over the next 5 years. This earnings unpredictability presents a direct conflict with Buffett's investment principles. He is known for seeking companies that deliver stable, recurring revenue with a clear path to long-term profitability. With Palantir, even though the company is growing quickly, its future financial picture is clouded by uncertainty that no financial model can fully account for. As a result, this inability to produce a confident long-term earnings estimate would be enough on its own for Buffett to pass. Now let's consider the third major strike against Palantir from Buffett's perspective. Its valuation. Even investors who are bullish on Palantir's future acknowledge that the stock is priced for perfection. At current levels, Palantir trades at roughly 103.9 times trailing 12-month sales and more than 238 times forward earnings. These kinds of multiples are rarely seen outside of early-stage tech startups or companies with revolutionary growth prospects. For context, even many leading software firms do not carry such high valuation multiples. Buffett, who studied under Benjamin Graham, the architect of value investing, continues to apply value-oriented metrics when evaluating opportunities. Though he has evolved and adapted over the years, he remains skeptical of paying sky-high prices for stocks unless their underlying earnings power is both massive and consistently growing. In Palantir's case, the company is growing, but is it growing fast enough to justify these eye-watering valuation ratios? In the first quarter of 2025, Palantir reported a year-over-year revenue increase of 39%. That is undoubtedly impressive. However, when we dig deeper, we find reasons to be cautious. The company's own revenue outlook for the full year anticipates a slower growth pace of approximately 36%. Meanwhile, the consensus among Wall Street analysts is that revenue growth will decelerate even further in the following year. This trend suggests that while the company is expanding, the pace of growth may already be tapering off, raising questions about whether the business can maintain the kind of exponential growth that would make its current valuation worthwhile. If future growth slows while the valuation remains high, the stock could become vulnerable to significant downward pressure. This kind of scenario is precisely what Buffett seeks to avoid. He has repeatedly emphasized the importance of having a margin of safety in his investments, meaning that he prefers buying stocks at a price below their intrinsic value. In contrast, Palantir appears to be priced far above what a conservative valuation model would suggest, making it an unlikely candidate for Buffett's portfolio. All things considered, it is hard to imagine a scenario in which Warren Buffett would seriously consider investing in Palantir. From its complicated business model, centered on artificial intelligence and government partnerships, to its unpredictable revenue stream and sky-high valuation, the stock conflicts with nearly every pillar of Buffett's time-tested investment framework. Although Palantir may well deliver strong returns in the future, and it may be a fine investment for those who understand the technology and can stomach the volatility, it is not a stock that aligns with Buffett's conservative, value-driven, and highly disciplined approach. But given what we know about his consistent investing principles, the likelihood seems extremely slim. In fact, if we are being honest, the idea that Buffett would not touch Palantir stock with a 10-foot pole may be an understatement. Considering the company's elevated valuation, complex business structure, and dependency on unpredictable government contracts, he might prefer to keep an even greater distance. Despite Palantir's stock surging over 70% this year, outpacing every other company with a market capitalization of at least $200 billion, Warren Buffett remains uninterested, and for good reason. First, Palantir operates in a highly technical space centered on artificial intelligence and government contracts, which lies outside Buffett's area of expertise, a critical factor in his investment decisions. Second, the company's unpredictable revenue, driven largely by shifting federal budgets and political winds, makes it nearly impossible for Buffett to forecast long-term earnings, a key requirement in his investment process. Lastly, Palantir's sky-high valuation, trading at around 103.9 times trailing sales and more than 238 times forward earnings, is far beyond what Buffett would consider reasonable, especially given slowing revenue growth projections. Altogether, these issues make Palantir fundamentally incompatible with Buffett's long-standing investment philosophy. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.